late night, they ain't getting no rest. Work so hard, people think I'm obsessed. Cream at the crop, won't settle for no less. Headed to the top, remaining so focused. Yeah, gorilla of the jungle, I've been beating on my chest. I learned from the struggle, it was all just a test.
Hey guys, and welcome back. So today I want to talk about high time frame trend-based accumulation. So this is a buying strategy that kind of helps you remove that emotion from the market. It's one of my favorite strategies to use. I just want to break it down a little bit more in depth. So you're going to hear me kind of say this. I've said it before, the trend is your friend until the end. So what we want to do is we want to be in the market when it's uptrending, and we want to either be sidelined or, taking profits, at least not buying into the market during a downtrend, because nobody really knows where the downtrend's going to end. So in certain assets, a lot of people start buying a lot higher. The price is downtrending. They continue buying all the way down. By the time we actually get to the lows, they don't have any money left to put into the market. Their cost basis is much higher, and they have to wait for that market to reverse, get back to their break even, and then hope for the continuation from there. So the reason we take a look at technical analysis is because it removes that emotion from the market. It removes the guessing work, where we can tell which way the market is trending based on all the different little tools, skills that I do teach. So we're going to talk about that right now. This is the SPY here. I've circled a bunch of different instances here where we have uptrends, and you can see basically all these different times offered pretty good opportunities to trade the market, not even targeting the exact low, and you're still getting really good returns on these moves. It comes out to about 600 or over 600% returns over 30 years. So you're looking at an average of 20% or more per year. So more than double outperforming the vast majority of the market or the general returns by the SPY on an annualized basis. So just breaking it down, we see here every time we go on these big uptrends, we have what eventually slows down, and we need to come back and retest support, retest these lower levels before we can continue up. That's just the way it is. That's why technical analysis seems to work a lot of the time, is because we do come back and retest those levels of support or resistance before continuing. So if we can identify when the trend has started and get in near the bottom of it, and then also identify when we've started to get a little bit overheated, when the trend is slowing down, that can allow us to either take profits, secure those gains, or it just allows us to take a bit more of a conservative, more of a protective position, looking at using stop losses to protect those gains, and not looking at being aggressive when we're at kind of an overheated nature where the trend is slowing down. So we just want to take advantage of that. So in the uptrends, we're getting in as early as we can in that confirmed trend reversal, riding it until we get those warning signals to the upside, sidelining ourselves, either taking profits or just sitting on our hands, waiting for the retracement back to those low ranges here, and then doing the same thing. So essentially we're just rinse and repeating. It's the same process over and over. So we can see here, 7 different times we've had little mini uptrends within the market, followed by these consolidation or these downwards price action trends here. So you don't want to be buying into a downtrend because you're not sure where that downtrend is going to bottom. You could be out of money by the time we get to the lows. That is a common problem. That happened to me in my first Bitcoin cycle. I did really well. I traded it really well. I timed, profits very well, but I reinvested way too early. So that was the thing. I was buying the dip all the way down. By the time we got to the depths of the bear market, I was out of cash. I wasn't able to buy at the lows like I wanted to, and then I was ultimately having to either work extra hard, get the extra capital that I can put in the market, or I'm stuck just waiting for price to kind of come back up to my cost basis. And so there is kind of the downside of buying into something like this that is what we consider a falling knife when you're buying into downtrending price action. So what we kind of see here is how do we gauge whether it's an actual high time frame trend reversal versus, maybe it's just a bit of a fake out move. So that kind of where we look at our momentum indicators here on the weekly. So we're going to start on the weekly to get an idea of kind of the broad trend in the market, and then we're going to zoom into the daily, and the daily is going to give us those signals on the lower time frame that tell us, whether it's kind of more immediate danger, kind of if we need to be in or out of the market, bit on the lower time frame. That's going to give us more information. But essentially what we see here, you can see all this uptrending price action, and then you can see this downtrending RSI price action. So that's a massive bull or bearish divergence. So that's what if essentially you see this playing out, you know, price action continues up, but we're still getting that continued bull or bearish divergence here. You know, that's kind of a warning signal throughout this whole run. That being said, as you're kind of riding up here, you know, the price action is looking good. So you're maintaining those higher highs and higher lows. We'll zoom in to this specific trend here and see what's going on. But pretty much we had, sorry, excuse me, zoom in here. We'll double click that. So we see here kind of price action came down. We found our initial low here. We came bounce. We're just chopping around our high time frame uptrend moving averages, our trend-based moving averages. So the 50-day, the orange line, and the 200-day, the blue line here. And we see, you know, we put in a higher low. We put in a higher high, a subsequent higher low, another higher high. We had a bullish cross of the 50-day and the 200-day moving average. We're holding it as support. So for me, this is enough to say, you know, we're coming from very oversold territory on the RSI as well as oversold territory on the MACD, as we can see here. And we see right here that this was our warning signal. Look at that orange line getting above the blue line. That's that bearish momentum. So this is what tells me this is not the time to enter right here. And that's also why we don't enter just based on RSI and MACD. The RSI and the MACD can remain oversold or overbought for extended periods of time while price action continues trending up or down. That's what we saw here. So despite the fact we got to that oversold territory, you know, we still had to retest those lows. We didn't really gain that bullish momentum until over here in January, where we started to see that positive line break above the negative line. You know, so that is definite confirmation. You can enter there. You're in that trade, you know, getting in on the trend. If you want to be really conservative, put a stop loss below the support here. So if we do continue, if it's a fake out move, we break down, you've kind of mitigated your downside risk and then maximize the potential to the upside. But essentially, yeah, coming from that very oversold territory on the MACD RSI, we have our uptrending price action in terms of candlesticks. We've got that bullish cross and kind of the ideal setup for a macro uptrend with our moving averages. And then we've also got the directional movement index kind of confirming here that the bearish momentum is slowing down, the bullish momentum's picking up, and we could be on for that kind of next leg up in the market, and that's what we saw. So we saw this move here, 245% from the technical confirmation of trend change to the highs. So great opportunity for a trade there. As we're coming up, we start to recognize we get a bit of bearish divergence up here. So we'll see that's that bearish divergence continued here. We'd start to see our moving averages are looking a little bit weak here. So curling over, losing that momentum. We see our bearish cross here, coming back in, retesting, giving us that opportunity to de-risk here, either getting out of the market or, as I said, just saving our cash for lower targets to buy, and then not interested in buying into the falling knife, waiting for that price action. So you see over here now, we've come to our next trend here. We see this is the bottoming structure. We came in, we put in a low, we kind of matched the high here, put in a higher low. We had our bullish cross of the bullish cross of the 50-day, 200-day moving averages, you know. And then if we take a look at our indicators, again, coming from deeply oversold RSI, deeply oversold MACD, and we're also seeing that kind of the bearish momentum is slowing down all through this. And then right here, boom, confirmation, bullish momentum picking up. We get that breakout, we get that bullish cross of the 50-200-day, and we're on to riding the trend up again. And you can see essentially just kind of chopping above that 50-day for the most part, retesting the 200-day a few times, but maintaining that uptrend structure for this time being. And then you see what we saw again, this bearish divergence as price continues climbing, the RSI highs continue declining. So that signals to me You know, bearish divergence, the trend is fine for now because the price action and because the moving average structure. As I said, the RSI is that lagging indicator, but it's just that warning signal. So as we get up here, we recognize we lost this moving average structure here. So bearish cross, coming back, retesting, getting rejected here. So that is that opportunity to de-risk again as we get that rejection into resistance. And we also saw the bearish momentum picking up on the DMI, so that's another warning signal. You know, overheated on the RSI, MACD, bearish divergence, bearish momentum picking up on the directional movement index, and bearish price action on the moving averages and the candlesticks. So enough warning signs for us to either you book those profits or you just sit patiently. You're not putting your cash into the market until you get another opportunity, which is what we see right here. Same thing, guys. So this is what I mean. Look for those similarities. Deeply oversold RSI, deeply oversold MACD, but you can see where the lows actually line up are not where the lows of the RSI and the MACD line up. So that's when I talk about that lagging indicator. So just pay attention. We see the bearish momentum was still favored on the DMI up until here. So that's where the low actually came in. And then we see the bullish momentum picking up right here where that positive line gets above the orange line and above that ADX line. We had our bullish cross of the 50-day, 200-day again. We've got uptrending price action entering the market and another 60% move here, just this small little trend. And same thing that we had up here, you know, we came in, broke bearish cross of the 50-200 day, retest allowing us that opportunity to potentially de-risk here, but you might just sit out and wait on the sidelines. As I said, you don't have to take profits, but you know, when you recognize this weakness, if you have cash, just don't be in a rush to put it into the market. Wait for the price action to be more favorable. And then same thing, bearish divergence right here, guys. So a lot of similarities. We see that bearish divergence. We see our bearish cross of the moving averages. Candles are not looking good. So we are in that downwards price action consolidation phase. Ultimately going to the oversold RSI, MACD. We start to see the bearish momentum slowing down. We get back above. We now get our bullish cross. We can enter the market here somewhere in this range. And we're riding up again for a 67.5% move within this trend. And the same thing that we see, guys, bearish divergence, you know, getting a little bit more overheated. We start to see the bearish momentum picking up here and then all through here. So big warning signs on the directional movement index. And then we see our bearish cross of that RSI, again, giving us that back test into resistance to allow that opportunity to de-risk. So that's what I say. Nothing really goes straight up or down. You know, if you're worried, you want to de-risk and the market's dumped out. Kind of selling the lows isn't the best idea. Just waiting for that relief bounce that's likely inevitable is kind of going to give you the better opportunity to kind of get more value for what you're looking to sell. And then we see just letting price just chop around, do its thing. We sit on our hands, we wait for confirmation. So we see here we've got that higher low, higher high, that subsequent higher lows. We've got uptrending price action. We got our bullish cross on the 50-day, 200-day moving average again. We're coming from the bearish, coming from the oversold nature on the RSI and the MACD. We're see the bearish momentum on the DMI slowing down again, bullish momentum picking up, and then that is the next trend right here, offering a 50% return. And same thing, so bearish divergence, you know, coming from oversold territory, losing that trend strength. So we see here getting to an extension there, losing the trend strength, bearish cross of the moving averages, retest, offering that opportunity to de-risk right near the highs, and then sitting on our hands, waiting again. This one right here, the reason I didn't actually kind of include this is because if I were to enter this position here, essentially what I would do is I'd probably have a stop loss just below here kind of as support, and then ultimately that would have got taken out during the COVID drop. That would be impossible to really predict, so that is kind of why I just ignored that one, because I would assume based on the technical factor, you know, I would have missed this one because I likely would have been stopped out. That's fine, that's part of the game. We're not going to win them all. If we're winning more often than not, though, we're able to compound those returns. So after COVID, we saw coming to, again, deeply oversold RSI, MACD, bearish momentum favored right through here. Bearish momentum starts waning, slowing down. We get that higher high, higher low price action, bullish cross of the moving averages, and we're in that trend riding it again. Look at that 60% move, and same thing that we saw in the current rally. So again, bearish divergence, so into that downwards consolidation. We go into our bottoming phase here. We put in the higher low, higher high, subsequent higher low, bullish cross of the 50-day, 200-day, coming from oversold territory on the MACD RSI, and bullish momentum picking up on the directional movement index. So that's our signal to enter the market, ride that trend to the upside, and then ultimately we see here, this is our warning signal. Bearish cross, bearish candles. We did have the bearish divergence that I talked about, and we see that our momentum is kind of coming back down here on the weekly. So not really sure where this is going to bottom, and this is what I'm talking about. We're in kind of this transitionary phase here, so not interested in really buying too heavily into the falling knife. That being said, I have kind of talked about DCAing in terms of long-term positions. There's no harm in kind of buying into a 20% plus correction in the major stock markets, historically speaking. That being said, is it the most opportunistic time to be heavily accumulating? I can't say so. The technical don't really let us know yet. So without the confirmation, we're not taking the additional risk. But to me, there's not a ton of risk in DCAing a large correction in the SPY, in the NASDAQ, or in any of your kind of world ETFs. So broad market indexes, those are long-term positions, generally less volatile, so definitely want to take advantage of the opportunities as they come. But that's kind of what I wanted to show you, just break down every single one of those little trends. So if we can capitalize on these little micro trends, we can really compound our returns. As I said, we're looking at about 600% returns throughout these trends. That doesn't even account for if you're taking profits up here and reinvesting them. That's going to help you amplify your returns. That's what I try to do. But yeah, just wanted to show you all the similarities within these trends and then how we gauge entering it. So right now we're kind of in the start, or at least the middle of what could be this downtrend. We're going to wait to see, we're going to wait for those weekly signals. We're going to look and see our price action. We want that uptrending. If we can get bullish divergence on the price action, even better. We did have a nice little buying candle in here. But ultimately, we want to see our directional movement index start to pick up, show a little bit more strength, a little bit more bullish momentum. For now, we're kind of just chopping away, too much uncertainty in the markets to really know what's going to happen. The trade war continues, so we're just kind of making a plan, how I gauge it, looking at it from the high time frame, so from the macro perspective. For a lot of people, you don't want to look at charts 24/7. You just want to get in and out of the market at opportune times. So doing something like a trend-based accumulation and distribution strategy could be a really good opportunity. By distribution, I just mean you're selling or taking profits and then kind of just rinse and repeat. That's the end goal. I'm going to flip over to the daily chart here. I want to zoom in on kind of the most recent trend, then just break it down. So when I talk about the high time frame, what I'm looking for is confirmation on the weekly chart, but I'm also going to really pay attention to the daily chart, because if we wait for the weekly to kind of give us those signals, we're going to be kind of a little bit further off the lows. We can sometimes get a better entry within the kind of the lower time frame, but we still want to look for confirmation in the least. So what we saw here, we came into our bottom range, started chopping around. What you see here, price was stuck under essentially all the major moving averages. So our 8-day and our 21-day EMAs and our 50-day and our 200-day SMAs. So the 50 and the 200 are our high time frame trend, and the 8-day and the 21-day are our low time frame trend. So here we got back above the 8-day and the 21-day. So that's the first step. We came from oversold territory on the RSI and MACD. We're starting to see that bullish momentum picking up on the DMI on the daily here, and then we see we've got that higher low, higher high, higher low, another higher high, another higher low. On the daily, we got this this bullish divergence, so the higher lows on the price action and the lower highs on the RSI. So for me, entering right here is the play. You know, we've got the bullish cross of our 50 and 200 day. We've got a bullish divergence on the daily. We've got that directional movement index bullish momentum picking up, and we're coming from oversold territory. So for me, that's the opportunity to enter the market. You know, you're not getting in right near the lows, but this is where the lows were. And if you're entering 8% higher, 9% higher than the lows, there's nothing wrong with that, especially when you're getting a 50-60% move. And then same thing that we saw to the upside, we saw this bearish divergence. So again, higher highs on the price action, lower highs on the RSI. We saw the MACD kind of losing momentum. We saw right here, this is where the DMI, that bearish momentum really picked up, shot up here, and we can see we've pretty much just put in those higher, we put in higher highs, but that's what I talk about, that bearish divergence. Although price was trending higher, the asset was not getting as extended on the RSI. That is a warning signal. So we just flip here to the actual price action. I'll show you where it reversed. So uptrending, higher highs, higher lows. Right here, lower high, lower low, lower high. That is your first signal that the trend is kind of slowing down. So we see there, the price action has changed. We see the bearish divergence on the RSI, and we see the bearish momentum picking up on the DMI. So right here is your signal to de-risk. You know, even if you de-risked right here, you came really close to nailing the top. So that's what the market will do. That's why we just follow the technical analysis. Right there, the market went up another 2.5%. You pretty much nailed the top, and you came pretty close. So within 10% of that entire trend, you essentially kind of came within those lows and highs. So that's a really good job, a really good opportunity, and it didn't cause you to buy that downtrend the whole time. So that's what I mean when I talk about kind of being patient, waiting for your entries, waiting for confirmation. A lot of the time your entry is going to be pretty similar regardless, so it doesn't hurt to me. I would rather wait for the confirmation, wait to know exactly which way that trend is going, rather than trying to guess and then getting caught on the wrong side. And then up here you can see our short-term moving averages losing that 50-day moving average, so a big bearish signal right there. We kind of had a big bearish candle price action in here, some pretty decent amount of selling, and then we also saw our 50-day curling over. So first kind of warning signals were right up here, and so we sold there. We're happy to take those profits, you know, put them in the bank, look to put them back in the market on a rainy day, and that's what we did. So we came back ultimately kind of in that downtrending price action, which we're still in. We're still stuck under all these moving averages. We put some more money back into the market around around 4,800. 48.50, that was our target range. So getting nice buys right near the lows. You know, waiting for that confirmation though before we're going to get aggressive. So that's kind of what I wanted to talk about. Just talking about accumulating based on trend and how it can really remove the emotion and still realize a lot of returns. You know, as I said, just within this trend alone, you came within 10% of the max potential returns just by riding the trend. So that's what I do. That's how I like to play things, you know, using a combination of both dollar cost averaging based on risk and as well as kind of a technical trend based accumulation strategy. So thank you so much for watching, guys, and I'll see you in the next one.